It's Monday, February 5th, and mortgage rates are back up over 7% this morning on the back of very strong economic growth data. When the economy is stronger than expected, job growth is stronger than expected, the bond market assumes that fewer rate cuts are coming. The 10-year bond yield jumped to 4.25% today, and that pushes mortgage rates higher too. Mortgage rates are 40 basis points higher than a month ago, 100 basis points higher than a year ago, and this is not a recipe to keep the buyer momentum that we saw building in December. As mortgage rates remain higher than last year, inventory is higher than last year as well. Remember that the path to more selection for home buyers is with higher mortgage rates. The higher rates makes higher inventory. Lower rates means lower inventory. And that's why at Altos Research, we track every home for sale in the country every week. We track all the pricing, all the supply and demand, and all the changes in that data so you can see it and understand it immediately as it happens. I'm Mike Simonsen. I'm the founder of Altos Research, and let's look at the details for the U.S. real estate market as we roll into February 2024. It is the spring buyer's market, and inventory is falling each week. That's not uncommon for February, and especially in the last few years, inventory would fall all the way into March or April. So this season seems to have shifted later in the year. So inventory is falling. There are more buyers than sellers right now. However, every week for several months, inventory continues to build relative to last year. We have slightly more sellers now than we did a year ago, and inventory is now 8.8% higher than last year at this time. There are 497,000 single-family homes unsold on the market across the U.S. That's 5,800 fewer homes on the market now than last week. So while interest rates are off their peak of a couple months ago, when they were over 8% for the 30-year fixed mortgage, rates are still very high. And the fact is that the economic and jobs data keeps coming in so strong that the bond market has pushed mortgage rates back up again. So as of Monday, February 5th, the 30-year fixed mortgage rate is back over 7% again. That's, like I said, higher than a year ago and a month ago. So if you're paying attention, you know that rising rates creates rising inventory. And that's what we're showing in this chart. So 10 years of inventory trends. I've highlighted in green the periods when mortgage rates were falling. You'll see that inventory was also falling at those times. In 2020, rates fell dramatically and inventory fell dramatically. Now, in the last 2 years, we've seen generally rising rate environment and inventory rising at the same time. So there are now 8.8% more homes on the market than last year, and mortgage rates are 100 basis points higher than they were at that time. So next week, February 15th at 10 a.m. Pacific is our monthly webinar. In it, we get to spend an hour with all the data. It's changing very quickly. And if mortgage rates stay in the 7s this spring, that'll put a big damper on the housing demand, and it'll defy a lot of the expectations that people have made about this market. If you need to communicate with buyers and sellers about these crazy dynamics in housing, you should join us on that webinar. There's a link in the description below. That's next week, Thursday, February 15th. Click that link to register. These are limited to 1,000 attendees, and we always get way more than that who want to join, so reserve your spot now. Click the link in the description below. In this chart, at the left end of the chart, you'll notice that we used to have well over 1 million single-family homes on the market at a given time. If you're interested in when we get back to that old normal level, it'll take a few years with these conditions of higher mortgage rates to get there. A few years is the expectation. On the other hand, if rates fall down, buyers will gobble up more homes, and available unsold supply will shrink again. That inventory will shrink again. And so these are some of the details we'll cover in more depth in the webinar next Thursday. Each week, though, there are just a few more home sellers that are testing the market. This week, 7% more new sellers than the same week a year ago. 44,000 new listings on single-family homes this week, plus another 11,000 immediate sales, which were listed and are already in contract. The pace of the new sellers each week remains really restricted, but is showing some signs of easing. 7% more sellers now than last year is encouraging. It's not a lot. There were 28% fewer sales now than in 2019, for example, 28% fewer sellers. So each gray line here is a previous year with the new listings volume. January and February start low and usually climb pretty quickly. But you can see the dark red line for this year is only barely above last year, and last year was the fewest ever sellers. A little bit higher. We have few sellers now, not because rates are high now, but because they were so low for so long. So each year with higher rates means like 5 million more people have a higher cost basis in their home, and they're more likely to resell it rather than hold it. So you can see why it'll take several years of rates higher to get the sellers to come back to the market. If rates fall again, that creates more homeowners who don't want to sell. So look this year for continued expansion on the number of sellers. Hopefully we'll get to 10 to 15% growth over 2023. We're at 7% growth right now. That will allow more transactions to complete and create a healthier housing market. So I repeat, higher mortgage rates leads to more inventory. And that's really what we're seeing now. Meanwhile, the new contracts, the sales rate, is greater than last year, but struggling to really break out into growth. And I've talked about maybe seeing 15% home sales growth this year. This week, we saw 56,000 new contracts for single-family home sales, including those 11,000 immediate sales. So that's 2% more than last year. Any growth is good, but this is barely growing now. So the rate of sales is barely growing now as rates have moved back up to 7% or higher. The year-over-year growth rate in pending sales was actually much stronger in December than it was in January. We're showing a tiny bit of sales growth over last year. Now, still, there were more buyers than sellers this week, and inventory is falling. So it'd be really nice to see that 10 to 15% sales rate growth that we saw in December. It seems to me that the potential is there, especially because we had so many sellers holding off in the last 18 months. But after a month of rising mortgage rates, like that market momentum has slowed. Meanwhile, home prices continue to show no signs of abating, really, even in the face of these stubbornly high mortgage rates. The median price of single-family homes in the U.S. is just under $425,000 this week. Home prices climb, of course, in the spring. And this year is no exception. Home prices remain a few percent higher than last year at this time. And so far this year, there have really been no signs of home prices retreating at all. Really no signs of big increases in the data either. As mortgage rates jump, though, the scenario of big increases grows less likely. The dark red line here is the multi-year path for home prices in the U.S. And I've added a dotted line so you can see home prices how they're a few percent higher than last year at this time, and likely to hit the new all-time highs in May. The price of the new listings is the bright red line, and the new listings this week came in at $399,000, which is roughly unchanged from last week and 5% greater than last year at this time. New listings prices continue to reflect a market with sufficient buyer demand for the available supply anyway. In February a year ago, we were seeing year-over-year declines in the new listing price, and that led to the home sales price declines in April, May, June of last year. Pricing pressures a year ago were kind of negative, and now they are positive. Prices in some ways are the slowest indicator in all the Altos data. We have all these ways to measure subtle shifts in supply and demand, but home sellers have some inertia on their asking prices once the house is listed. So it takes longer for those demand shifts to show up in the price data, and even longer to show up in the sales price data Homes that are on the market now get offers in February and March and close in April. So then you start seeing those sales price data in May and June. But you can see it right now that there's no real downward pressure on home prices yet. On the other hand, the price reductions data is very sensitive to changes in home buyer demand. When mortgage rates jump, fewer offers get made, and so some sellers cut their prices. This happens immediately with mortgage rates, with a spike in mortgage rates. Currently, 30.6% of the active sellers have felt the need to cut their asking price from the original list price. That's in the normal range for this time of year. And it implies so far that people are buying homes at these prices. Normally, about a third of homes take a price cut before they get an offer. And in this chart, you can see every line is a year. The dark red line is starting at the left end of the chart for 2024. And if you look closely, you can compare the slope of this year's line with last year's brighter red line and see them converging a bit. The mortgage rates a year ago were falling in January, and buyers who were shopping at that time took advantage. Mortgage rates rose this January, and so the price reductions data shows a little sensitivity to that. Little sensitivity meaning that they're converging a little bit. Last year, the market was finding a bottom. This year is slower expansion. And I point this out because it really illustrates how to measure the consumer sensitivity to changes in mortgage rates. This week, as mortgage rates jumped back over 7%, I can expect we'll see a slowdown in the price reflected in the price reductions data soon too. Now it's the spring, so there's still fresh inventory with fewer price reductions. So it's a slope change that we'll be watching for in the next week or two. We'll spend more time on how you can track this phenomenon in the webinar next Thursday, next week, February 15th at 10 a.m. Pacific. There's a link in the description below. Book your space to join us. Save your spot right now. It can be really hard to communicate all this with buyers and sellers, but there are folks on the sidelines who are like waiting for rates to drop so they can swoop in for sudden bargains. But they may not realize how much competition is waiting right alongside with them. And meanwhile, mortgage rates are actually increasing. So if you need to help buyers and sellers see the actual data right now, you should join us at Altos. Go to altosresearch.com, book a free consult with our team. We'll help you know how to talk about the market with your clients and prospects today. There's a link in the description below to join us at Altos, so click that and let's get started.